Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalysts talk. Today we're looking at applied optoelectronics.
If you find our talks useful, please consider subscribe, like, and comment underneath.
Yeah. So think about artificial intelligence for a second.
Okay.
What if I told you the absolute biggest bottleneck in AI right now, it isn't the microchips?
Right. Everyone thinks it's the chips.
Exactly. And it isn't the software either. It is actually the physical fiber optic cables connecting all those processors together.
Yeah, and that is exactly the realization the market is kind of waking up to right now, because we have a massive story to unpack for you today.
We really do. The entire financial sector is watching applied optoelectronics. Right now, the ticker is AAOI, by the way.
Uh-huh.
And what you're witnessing here, it's a complete structural paradigm shift. Like, this is a company transitioning from being a traditional legacy optical component maker into, well, a critical tier 1 infrastructure player for this global AI supercycle.
Right, and we aren't just talking about, a speculative pivot either.
No, not at all. This shift is actively being validated by recent multi-hundred-million-dollar orders coming straight from the major hyperscalers. So if you want to understand how the physical architecture of AI is actually being built from the ground up, this is absolutely the stock you need to pay attention to.
Definitely. But before we get into the heavy analysis of today's stock, here is a highly useful chart tool for investors and traders trying to navigate these wild markets.
Yeah, the volatility is crazy right now.
It really is. So if you want help reading trading charts more clearly, you can check out VIP Algos. The link is below in the description. VIP Algos is a TradingView indicator suite that provides visual buy and sell chart alerts, trend direction tools, support and resistance zones, and even take profit and stop loss planning areas.
Which is super helpful.
Yeah, and it can be used across markets like stocks, forex, crypto, gold, indices, futures, and more. Just remember, though, VIP Algos is an educational chart analysis tool only. It is not financial advice, it does not place trades for you, and it obviously doesn't guarantee profits. Trading involves risk, so always manage your risk and do your own research. That is an affiliate link, so we may earn a commission if you use it at no extra cost to you.
All right, so let's dive into the wealth building context here.
Okay, let's do it.
Because when you look at a stock experiencing this kind of massive momentum, it is incredibly easy to get caught up in the day-to-day noise.
Yeah.
I mean, the intraday swings alone can be blinding.
Oh, absolutely.
But we have to zoom out for a second and ask, why does this actually matter for a long-term portfolio?
Exactly, because this is not just a short-term momentum trade. What we are looking at is essentially a generational S-curve adoption phase. If you think about the infrastructure required to run artificial intelligence, you have to picture these massive AI clusters. These are gigantic data centers filled with thousands of GPUs, and they are incredibly power hungry.
Right. The electricity required just to run the data transfer alone is staggering.
And that brings us to the concept of the AI tax.
Yeah, the AI tax. I love that term. Because if a company like NVIDIA is selling the massive high-performance engine for AI, Applied Optoelectronics is building the fuel lines.
That's a great way to put it.
Right. Efficient optical infrastructure. The actual physical fiber optic technology transmitting data at the speed of light between these processors. It's essentially the toll road tax that tech companies just have to pay to build their data centers.
Because you simply cannot scale artificial intelligence without vastly upgrading the optical networks, right? Otherwise, they just overheat and can't handle the sheer volume of data.
Exactly. And that is exactly the space Applied Optoelectronics occupies right now.
Okay, that is a great way to visualize it for everyone listening, but that brings up a really crucial point. If we're looking at this from a wealth-building perspective, who is this stock actually for?
Good question.
Because, from what I'm seeing on the charts, the volatility here is absolutely intense. If you're checking your portfolio every day, this thing will give you total whiplash.
You are entirely right to point that out, and we need to be very clear about the investor profile here. This absolutely fits a high-growth, high-risk profile.
Yeah, for sure.
For an investor looking for safety or, reliable dividend income or a low-beta defensive play, this is categorically not the right fit.
Not at all. The volatility alone might shake out a conservative investor within, a week.
Oh, easily. But for those looking for multi-year infrastructure growth investors who are trying to position themselves ahead as a massive hardware upgrade cycle over the next 12 to 24 months, this presents a highly compelling, albeit speculative, opportunity.
Okay, so you mentioned this generational shift. But when a company tries to scale that fast to meet this kind of demand, they usually burn through a mountain of cash.
Oh, yeah.
So are the fundamentals actually supporting this hyper-growth narrative, or are they just bleeding money? Let's look at the numbers.
Yeah, let's get into the numbers because they illustrate an explosive trajectory, but they definitely require context. So for fiscal year 2025, they hit a record revenue of $455.7 million.
Wow.
Yeah, that is a staggering 82.8% increase year over year. And it's being heavily driven by their data center revenue. But what's truly making Wall Street pay attention is management's forward guidance.
Right.
For fiscal year 2026, they are projecting an acceleration to $1.1 billion in revenue.
Okay, wait. Let me stop you there and push back a little.
Sure.
Because when you look under the hood, the profitability metrics tell a much more complicated story.
They do.
They reported a GAAP net loss of $38.2 million for 2025, and they're operating with an EBIT margin of negative 9.5%. So my question is, if the revenue is skyrocketing by almost 83%, why in the world are they still posting those kinds of operating losses?
It is a totally valid skeptical question. And honestly, it's exactly what the bears point to.
Yeah.
But you have to look at the sequence of the financial inflection.
Okay, explain that.
Yes, the annual GAAP number, the generally accepted accounting principles number, it was a loss. But they actually turned non-GAAP profitable in the fourth quarter of 2025.
Okay.
What you really want to look at to understand the underlying business health is the gross margin. That expanded to 31.4% by the end of the year.
Okay, 31.4%. And why is that gross margin expanding so rapidly?
Because they are shifting their product mix to higher-end 400G and 800G products.
Got it.
For context, 400G and 800G, that refers to the data transmission speeds 400 gigabits and 800 gigabits per second. These are essentially the ultra-fast data cables that modern AI chips require to talk to each other without lagging.
Right. And those obviously carry a much higher profit margin.
Exactly. So the reason the operating margin, the EBIT, is currently negative is due to heavy, aggressive capacity investments.
They're spending to grow?
Precisely. They're pouring money into scaling their operations to meet the demand of that $1.1 billion guidance. It's the classic dynamic of front-loading your capital expenditure to grab a massive market share before your competitors can even react.
Okay, speaking of massive capital expenditure, we really have to talk about the balance sheet.
Yeah.
Because they just executed a massive $250 million at-the-market equity raise.
Yeah, that was huge.
And an at-the-market, or ATM, offering, it means they are selling new shares directly into the open market, which, that dilutes existing shareholders.
It does.
Right now, they have a $260 million cash position, plus $125 million in convertible debt due in 2030. So that is a lot of capital moving around.
It's a massive war chest.
Right. So essentially, they're diluting the stock today to buy the massive shovel they need for tomorrow's gold rush. But $250 million is a very big shovel. What exactly is this war chest for?
Your shovel analogy is spot on. This massive cash raise is specifically to de-risk a $150 million build-out of a brand new manufacturing facility in Texas.
Okay.
Think about the dynamics at play here. When you have top-tier hyperscalers, the biggest tech companies in the world, knocking on your door, wanting hundreds of millions of dollars in product, your biggest risk isn't demand.
Right. The demand is obviously there.
Exactly. Your biggest risk is whether you can actually manufacture it flawlessly and fast enough. So that cash buffer ensures they can complete this Texas factory without risking a credit downgrade or, running out of runway.
Makes sense. But why Texas? Is that just to avoid the geopolitical risks of manufacturing overseas, or is there more to it?
It's a combination, really. It's avoiding overseas tariffs, protecting intellectual property, and having direct physical proximity to the U.S. data centers being built.
Because when hyperscalers need custom parts fast, they want a domestic supply chain.
Exactly. And this ties directly into their competitive moat, the actual technology they are building in that factory.
Right. Let's unpack the technology itself. How exactly are they differentiating themselves from all the other optical networking players out there? Because it's a crowded space.
It is, but it comes down to a breakthrough called linear pluggable optics, or LPO technology. Let's break down how a traditional optical transceiver works.
Okay.
Its job is to take electrical signals from a computer and translate them into pulses of light to travel down a fiber cable. Usually it requires a component called a digital signal processor, or DSP, to clean up the signal.
The DST, right.
Yeah. Imagine a traditional transceiver as a race car that is forced to carry a massive, heavy generator in the trunk. That generator is the DSP. It uses a ton of power, it creates a massive amount of heat, and it just slows the car down.
So what Applied Optoelectronics has done with their LPO tech is essentially they just remove that heavy generator entirely.
Exactly. They remove the power-hungry middleman.
Yeah. Wow.
And by doing that, they reduce the power consumption of the transceiver by roughly 50%, and they significantly lower the latency, the delay in data transmission.
And in an AI data center, where electricity limits and cooling requirements are the absolute biggest bottlenecks to growth,
Mhm.
I mean, cutting the power consumption of your optics by 50% is a complete game changer.
It's massive.
That makes perfect sense. And from what I read, they also control their own manufacturing right down to the base materials, right?
Yes, and this is crucial. Unlike their competitors who outsource parts to third-party foundries, they manufacture 100% of their own indium phosphide lasers in-house.
Okay, so total vertical integration.
Yeah, when you control the lasers, you control the quality. This cuts down their defects to under 50 parts per million. Plus, it slashes their labor hours because they've custom-built their own automation machines to assemble them.
Okay, so they have the shovel, the technology clearly works, and they have the cash. The question you're probably asking right now as you listen is, when do they actually strike gold? Let's move to the catalyst timeline. What are the specific milestones we need to be watching here?
The absolute critical window to mark on your calendar is the third quarter of 2026.
Q3 2026, got it.
That is when this new 210,000 square foot Texas facility is expected to officially start production. This is the inflection point where the company transitions from being capacity constrained, meaning they physically have more orders than they can fulfill, to becoming a massive scaler capable of handling Tier 1 volume.
And early Q3 2026 is also when volume shipments for that landmark $200 million 1.6T transceiver order are expected to begin.
Yes.
And for context, 1.6T is the next generational leap in speed, 1.6 terabits per second. The market widely suspects this massive order is from Microsoft or Oracle.
That's the rumor, yeah.
But here's my question. Given how closely Wall Street is watching this Texas build-out, is all of this already priced into the stock, especially with the Q2 2026 earnings expectations looming right around the corner in August?
Well, it's the classic market dilemma. The market is certainly trying to price in the perfect execution of this factory, but there are broader macro tailwinds that add layers of potential upside that are, frankly, very hard to fully quantify on a spreadsheet right now.
What kind of macro tailwinds are we talking about?
For example, the U.S. CHPS Act.
Oh, right.
This legislation provides massive financial incentives and grants for domestic semiconductor and high-tech manufacturing. Since they're building this massive footprint in Texas, they're perfectly positioned to benefit from federal money.
That makes a lot of sense.
Furthermore, there are ongoing strict export restrictions on Chinese high-end optical technology,
Right.
which essentially isolates the U.S. hyperscaler market, creating a protected sandbox. Applied Optoelectronics can dominate this space without facing artificially cheap pricing pressure from state-subsidized overseas competitors.
Okay, so we know the business catalysts in the macro environment, but what does the actual price chart tell us?
Yeah, let's look at the price action.
Because the price action here is exactly what you'd expect from a high beta momentum stock riding a technological wave. And by high beta, I mean a stock that moves with much greater velocity and volatility than the overall market.
Right.
The sheer velocity we're seeing is stunning. A rolling annual return of 316% and a 120-day gain of 247%.
The gains are massive, but as you know, it hasn't been a straight line up.
Oh, not at all. If you are looking at the chart, you'll see a brutal 28.35% sell-off that happened recently.
Yeah, that was a tough week.
That plunge was directly triggered by the market's fear over that $250 million at-the-market dilution we just talked about. Investors just panicked about their shares being devalued.
It was a sharp drop, absolutely. But what is highly instructive for you to understand is how the stock behaved immediately afterward.
Right.
It swiftly rebounded. Following their product showcase at the OFC 2026 Optical Networking Conference, the stock surged 12.85%. What this aggressive rebound shows us is that there is incredibly strong institutional accumulation happening on the dips. Whenever the stock pulls back on a scary financing headline, big institutional buyers step in aggressively.
Because they're looking past the dilution and focusing entirely on the long-term AI infrastructure thesis.
Exactly.
It is extremely volatile, though. I mean, the daily volatility is regularly hitting 15%.
Yeah, it's wild.
If you're watching a stock swing 15% in a single day, you're probably wondering if you've already missed the boat or if you're about to catch a falling knife. It can be incredibly difficult to navigate emotionally.
Oh, totally.
This is exactly why having clear visual structure, like we mentioned earlier, with indicator suites that help identify support and resistance zones can be so vital. You need a system when the price action is this explosive so you don't get shaken out by intraday noise.
Definitely.
So the chart gives us the volatile price structure, but what does the actual market sentiment look like behind the scenes?
Well, it seems like Wall Street is completely polarized on this one. It's a true battleground stock. On one side, you have analysts at Rosenblatt Securities calling it the absolute purest play on the optical AI tax, and they've slapped a massive street-high price target of $140 on it.
But then on the exact opposite end of the spectrum, you have Needham maintaining a strict hold rating.
Yeah.
Their argument is that the valuation is incredibly rich, pointing out that it is trading at over 30 times 2027 projected earnings. They are essentially saying, yes, the growth is there, but you're paying today for perfection 3 years from now.
The analyst community is definitely split between the growth believers and the valuation skeptics. But if you look at where the actual smart money is flowing, institutional funds aren't waiting for the analysts to agree.
Right. Who's buying?
We are seeing major moves from funds like Synctive Capital and Portalon Capital, who have heavily increased their stakes recently. They're building massive positions because they see the concrete hyperscaler contracts as all the validation they need.
There is also a lot of speculative buzz adding absolute fuel to this momentum fire, too. I'm seeing persistent M&A rumors circulating about potential buyouts by larger semiconductor giants like Broadcom or Marvell.
Oh yeah, the M&A rumors.
The theory is that those giants might want to swallow up Applied Optoelectronics just to acquire that low-power LPO technology and vertically integrate their own AI networking portfolios. Plus, there is this whole narrative building around made in USA sovereign AI contracts.
We have to be crystal clear here, though. Both the acquisition rumors and the sovereign AI defense contracts are completely unconfirmed.
Right. They are rumors.
But you are right. They are absolutely adding intense speculative fuel to the sentiment. When you combine concrete $100 million hyperscaler orders with the potential for federal CHIPS Act grants and the premium of a potential M&A buyout, the narrative just becomes a magnet for momentum capital.
Okay, that sentiment picture is fascinating, but we need to bring this back down to earth and talk about the risks.
Yes, we do.
Because the execution anxiety here is incredibly real. You might be hearing that $1.1 billion revenue projection and thinking it sounds too good to be true. And I want to remind you that this company has a history of somewhat erratic execution.
They do.
Just recently, they actually missed their 800G revenue expectations. Why? Because of ongoing firmware optimization issues.
It is a stark reminder that designing a cutting-edge piece of technology in a sterile lab is very, very different from flawless volume manufacturing.
Exactly.
We're aiming to hit a target of 500,000 units per month. That is a monumental, incredibly complex operational task.
And then there is the massive valuation risk. Trading at a price-to-sales ratio of 15.3 leaves literally zero room for error. Everything has to go perfectly.
Yep.
Furthermore, manufacturing in the United States, while fantastic for supply chain security and avoiding tariffs, it comes with labor and operational costs that are roughly 10 to 15% higher than manufacturing in Asia. If demand from these hyperscalers falters even a little bit, or if there is an economic slowdown, those higher fixed costs from the Texas facility are going to severely pressure their near-term margins.
I completely agree, and that is the defining vulnerability of this entire thesis. The current valuation assumes flawless execution of the S-curve ramp.
Flawless.
If there's any delay in bringing that Texas facility online in Q3, or if they experience yield hiccups where the defect rate spikes as they scale up to that 500,000 unit mark, the market will not be forgiving.
The stock will face a brutal derating.
Exactly. The higher U.S. manufacturing costs are a real headwind, though so far, the major tech customers have shown a strong willingness to pay that premium for the security of a domestic supply chain. But the operational tightrope management is walking right now is very, very thin.
So with everything on the table, the hypergrowth, the LPO tech advantage, the macro tailwinds, but also the extreme valuation and the execution risks, what is the final verdict here?
Based on the research, we arrive at a bullish score of 8 out of 10.
Okay, 8 out of 10.
To summarize the stance, This is arguably the purest play on the AI optical supercycle available in the market today. Their vertical integration, the in-house laser manufacturing, and that low-power LPO technology are exactly what power-starved hyperscalers desperately need right now.
Right.
But, and this is a major caveat, it requires a multi-year hold horizon. We are talking 12 to 24 months to capture the full product cycle and truly see the operational leverage from that new Texas facility. You have to be willing to endure the extreme 15% daily volatility to ride out the S-curve adoption phase.
And as always, we have to explicitly state that we are not telling you to buy, sell, or hold. This is purely an educational analysis, and you must do your own research to see if this fits your personal risk tolerance and portfolio strategy.
It's exactly like we talked about earlier with the concept of the optical toll road tax. As artificial intelligence grows, the physical highway has to be built, and Applied Optoelectronics is currently laying down the most advanced pavement.
I love that.
But building highways is messy. It's expensive, and it's full of construction delays. The core question you have to answer is whether you believe management can finish the road on time.
Before we wrap up, here's a final provocative thought for you to chew on. We talked about sovereign AI earlier, the idea that individual countries will want to build their own independent AI data centers.
Right.
If that mandate takes off globally and every major nation demands domestic infrastructure, how long until these advanced optical components are classified not just as tech hardware, but as critical national security assets?
Oh, wow.
Right. If the government steps in to protect this supply chain, that could change the valuation model entirely.
That is a fascinating angle to watch over the next 24 months.
Absolutely. And if you want a cleaner way to read the trading charts as you analyze volatile companies like this, check out VIP Algos through the link below in the description. VIP Algos is a TradingView indicator suite featuring visual buy and sell alerts, trend direction tools, support and resistance zones, and TPSL planning areas.
It's a great tool.
It really is. It can help make these wild charts easier to scan. But remember, it is still only an educational chart analysis tool. It is not financial advice, it does not place trades for you, and it does not guarantee results. Trading involves risk, so always do your own research and manage your risk. This is an affiliate link, and we may earn a commission at no extra cost to you.
And if this analysis helped you, please subscribe, like, and comment underneath. We'll see you in the next Smart Wealth with Joshua.